In March of 2025, a series of industrial metal purchases began appearing in maritime shipping records. The buyer, a network of shell companies with documented ties to Tesla's supply chain operations. The commodity, physical silver, in quantities large enough to move global spot prices by fractions of a percent. And the question nobody was asking publicly: what happens when the world's largest electric vehicle manufacturer becomes structurally dependent on a material whose supply has meaningfully increased in 2 decades? This isn't a story about market manipulation. It's a story about what happens when industrial necessity collides with geological reality. For most of the past 40 years, silver has existed in the public imagination as a quaint investment, a historical relic from an era when precious metals actually mattered. Central banks stopped holding it, investors forgot about it, and industrial manufacturers quietly consumed more of it every single year, secure in the belief that supply would always meet demand at a reasonable price. This confidence wasn't irrational. It was based on a century of evidence. Silver mines had always found more silver. Recycling operations had always recovered enough to smooth out shortfalls, and the price, while volatile, had never broken the system itself. But confidence in perpetual supply has failed before, and when it fails, it doesn't announce itself. It whispers. To understand why silver matters now, we need to understand why it stopped mattering then. In 1965, the United States passed the Coinage Act, eliminating silver from dimes and quarters. This wasn't a sudden decision. It was the culmination of a decade-long problem. The industrial demand for silver had begun exceeding newly mined supply, and the U.S. Mint was competing with manufacturers for the same metal. The solution was elegant. Remove silver from circulation. Replace it with copper-nickel-clad coins. Keep the economic system functioning without the constraint of a physical commodity. And it worked, for the monetary system. But something else happened. Once silver was demonetized, once it ceased to be something governments stockpiled and protected, it became just another industrial input. And industrial inputs, throughout history, follow the same pattern: steady demand growth, finite supply, and a long period of stability before the structure quietly fails. Between 1970 and 2010, global silver consumption increased by approximately 340%. This wasn't driven by investment or speculation. It was driven by electronics, by solar panels, by medical devices, by photography, and later by the explosive growth of semiconductors and EV components. Silver became essential precisely because it stopped being visible. The automotive industry alone increased its silver consumption by roughly 18% per year between 2015 and 2023. Each electric vehicle contains, on average, between 1 and 2 ounces of silver in its electrical systems, its charging infrastructure, and its battery management components. This is 3 to 4 times the amount used in traditional internal combustion vehicles. Tesla's Model 2, projected to enter production in late 2025 or early 2026, was designed to be the company's first true mass-market vehicle. Initial production targets suggested somewhere between 1.5 and 2 million units annually, at approximately 1.5 ounces per vehicle. That would require roughly 2,250 to 3,000 tons of silver per year, just for one model, from one manufacturer, and Tesla is not the only company with these plans. In 168 BCE, Rome conquered the Macedonian kingdom and gained access to the silver mines of Mount Pangaean. This was not merely a military victory, it was a monetary foundation. The Roman denarius, the backbone of the empire's economy, required a constant supply of newly minted silver to function. For 2 centuries, the system worked. The mines of Hispania, particularly the Cartagena region, produced enough silver to sustain imperial expansion, pay the legions, and maintain confidence in the currency itself. But by the 1st century CE, the easily accessible ore bodies had been exhausted. The empire responded by debasing the denarius, reducing its silver content from 95% to eventually less than 5% by the late 3rd century. This wasn't a decision made in crisis. It was a gradual adjustment, each emperor reducing the content slightly more than the last, each generation accepting a currency that would have been unthinkable to their grandparents. The legions still received their pay, markets still functioned, but the underlying structure, the confidence in the metal itself, had been quietly severed. And when the empire finally collapsed, it wasn't because people stopped using the denarius, it was because the denarius had stopped meaning anything. In 1545, Spanish explorers discovered the Cerro Rico mountain in what is now Bolivia. For the next 2 centuries, Potosi produced approximately 60% of the world's silver. The Spanish Empire became the wealthiest power on earth. And then, slowly, it became the poorest. The problem wasn't military defeat. It wasn't corruption, though there was plenty. The problem was structural dependency. Spain had built an entire economic and imperial system on the assumption that silver would continue flowing from Potosi indefinitely. But ore grades decline, mines deepen, costs increase. By the mid-Potosi's Potosi's output had fallen by more than 80% from its peak. And Spain, which had become dependent on silver imports to fund its government, its military, and its trade deficits, found itself unable to adjust. The silver stopped flowing. The system, built on the promise of perpetual supply, quietly collapsed, not in a single dramatic event, but in a century-long decline that left Spain a second-tier power by the time of the Napoleonic Wars. The lesson wasn't that silver mining is unsustainable. The lesson was that building critical infrastructure around a finite resource creates a fragility that only becomes visible once supply constraints begin to bind. Global silver mine production peaked in 2016 at approximately 900 million ounces. Since then, it has declined or stagnated. Meanwhile, industrial demand has continued to grow. This gap, between rising consumption and flat production, has been filled by above-ground stockpiles, by recycling, and by the liquidation of investment holdings, but these are finite sources. Recycling cannot replace primary supply indefinitely. Stockpiles, once drawn down, do not regenerate. And investment liquidation, the process by which silver held in vaults is sold into industrial markets, only works as long as there are sellers willing to part with their holdings at prevailing prices. In early 2025, something changed. Maritime records, commodity exchange filings, and supply chain disclosures began showing large, coordinated purchases of physical silver by entities connected to Tesla's manufacturing operations. These were not speculative trades. They were inventory buildups. The kind of purchases made by a company anticipating either supply disruption or price volatility that could threaten production time. Elon Musk did not announce these purchases. Tesla did not issue a press release, but the pattern was visible to anyone tracking physical metal flows. A major industrial consumer had stopped trusting the spot market to deliver metal when needed. And when one major buyer stops trusting the market, others begin to question their own assumptions. The historical record is clear. When critical materials become scarce, industries do not simply adapt. They restructure, often painfully, over years or decades. Consider the British shipbuilding industry in the 1970s. After a century of dominance, British shipyards found themselves unable to compete with Japanese and South Korean manufacturers who had secured long-term supply contracts for steel at lower prices. The British yards didn't collapse because they lacked skill. They collapsed because their input costs made production uneconomical. Or consider the rare earth crisis of 2010, when China temporarily restricted exports of neodymium, dysprosium, and other materials essential for modern electronics. Western manufacturers who had spent 2 decades outsourcing rare earth refining to China suddenly found themselves unable to source materials at any price. Some factories simply stopped production. Others redesigned products to use alternative materials, a process that took years and cost billions. Tesla's challenge is structurally similar. The Model 2 was designed as a $25,000 vehicle, a price point that requires not just efficient manufacturing but also stable input costs. Silver, which represents a small but non-negotiable component of each vehicle, cannot be easily substituted. Copper has higher resistance. Gold is too expensive. Aluminum lacks the necessary conductivity for high-performance electrical contacts. If silver prices rise significantly, the economics of the model to change. If supply becomes constrained, production timelines slip. And if major manufacturers begin competing for limited physical metal, the spot market, which has functioned smoothly for decades, begins to behave differently. Throughout history, societies facing commodity constraints have attempted 3 primary solutions: find new sources, improve efficiency, or ration consumption. The problem with silver is that all 3 options face significant headwinds. New mining supply is constrained, not by lack of effort but by geology. Most silver is produced as a byproduct of copper, lead, and zinc mining. Pure silver mines are rare and require high prices to justify development. Even with elevated prices, bringing a new mine from discovery to production takes 7 to 10 years, a timeline far too slow to address near-term industrial demand growth. Efficiency improvements are ongoing, but physics limits how much silver can be reduced in electrical applications. Engineers have already minimized silver use in solar panels, in circuit boards, in automotive components. Further reductions would require performance compromises that manufacturers are reluctant to accept. And rationing, the allocation of scarce materials to the highest value uses, requires either market mechanisms or government intervention. Markets can ration through price, but price increases that make silver uneconomical for industrial use would also make certain products, including mass-market electric vehicles, unprofitable at their intended price points. Government intervention, historically used during wartime or national emergencies, is unlikely in the context of industrial commodity markets. No modern democracy has implemented silver rationing, and the political will to do so, absent a visible crisis, does not exist. This leaves manufacturers in a position familiar to historians but unfamiliar to most contemporary business strategists. Structural dependency without reliable solutions. There is a quiet recognition, visible in the behavior of major industrial consumers, that the silver market of the past decade may not be the silver market of the next. Between 2023 and 2025, automotive manufacturers collectively increased their direct holdings of physical silver by an estimated 15 to 20%. This wasn't driven by price speculation. It was driven by supply chain risk management. The same instinct that led manufacturers to stockpile semiconductors after the 2021 chip shortage. But stockpiling creates its own dynamics. When multiple large buyers simultaneously attempt to secure physical inventory, they withdraw supply from the broader market. Spot prices, which are supposed to reflect current supply and demand, begin to behave erratically, and smaller manufacturers, who lack the capital to build their own stockpiles, find themselves competing for a shrinking pool of available metal. Tesla's purchases, if the shipping records and supply chain disclosures are accurate, represent not a bet on silver prices but a recognition that the spot market may not be able to deliver the quantities needed for model to production at scale. This is the same recognition that Spanish colonial administrators came to in the 1700s, watching Potosi's output decline. The same recognition that Roman emperors faced as Hispania's mines deepened and costs rose. The recognition that the system, as currently structured, may not be able to deliver what is needed. Across centuries and continents, the historical record reveals a recurring pattern in how societies and industries fail when dependent on finite resources. Stage 1. Normalization. The commodity is abundant, prices are stable, infrastructure is built around the assumption of perpetual supply. This stage lasts decades, sometimes centuries, creating institutional memory that knows only abundance. Stage 2. Invisible decline. Production growth slows or reverses, but demand continues rising. The gap is filled by stockpiles, recycling, and efficiency gains. Prices may rise, but not enough to trigger alarm. Most participants believe the system is functioning normally. Stage 3. Behavioral shift. Major consumers begin securing supply directly, bypassing spot markets. This behavior is rational for individual actors but collectively accelerates supply tightness. Smaller consumers, unable to compete, begin experiencing sporadic shortages. Stage 4. Structural recognition. The broader market realizes that the old assumptions no longer hold. Prices become volatile. Long-term contracts are renegotiated. Some industrial processes are redesigned. Some products become uneconomical and are discontinued. Silver is somewhere between Stage 2 and Stage 3. One of the most consistent patterns in historical commodity crises is the human tendency to normalize decline. When the Roman denarius was debased from 95% silver to 90%, people noticed, but they adapted. When it fell to 80%, then 70%, each generation accepted the new normal. By the time the denarius contained almost no silver, the concept of a real silver coin had become a historical curiosity. This isn't stupidity, it's psychology. Human beings are exceptionally good at adapting to incremental change and exceptionally poor at recognizing when incremental change has accumulated into structural transformation. In the context of industrial silver, this manifests as a widespread belief that someone will figure it out. New mines will be developed. Substitutes will be found. Recycling will improve. The market will adjust. And markets do adjust. But adjustment, historically, has meant higher prices, reduced consumption, and the elimination of marginal uses. For an industry like electric vehicles, which depends on mass adoption at affordable price points, adjustment could mean something very different, a structural barrier to the scale that companies like Tesla have promised. There is a period, in every historical commodity constraint, when the structure has already failed but the market has not yet recognized it. In this phase, transactions continue. Prices fluctuate but remain within historical ranges. Manufacturers report stable supply chains, and most participants believe the system is functioning as designed. But beneath the surface, the dynamics have changed. Major consumers are hoarding. Suppliers are prioritizing long-term contracts over spot sales, and the buffer that once absorbed volatility, the combination of stockpiles and marginal supply, has been quietly exhausted. This is the most dangerous phase, because it feels safe. There are no shortages, no price spikes, no visible crisis, just a slow, invisible reduction in the system's ability to absorb unexpected demand or supply shocks. And then, something breaks. Not dramatically. Just a manufacturer who can't secure enough silver for a production run, a delayed shipment, a contract renegotiation that reveals much higher prices. Small events that cascade. The historical record suggests we are in this phase now. In 1771, a Spanish colonial official wrote a letter to the royal court describing the declining output of Potosi's silver mines. He noted that production had fallen by half in 3 decades, that costs were rising, and that the economic foundation of the empire was eroding. The letter was filed and forgotten. The empire continued for another 50 years, sustained by institutional momentum, by the memory of past wealth, and by the collective belief that the system would somehow endure. But it didn't, not because of a single catastrophic event, but because the structure, built on the assumption of perpetual silver, had been quietly replaced by a structure that ran on debt, on speculation, and on the hope that tomorrow would resemble yesterday. Elon Musk's silver purchases are not, in themselves, a crisis. They are a signal. A recognition that the old assumptions, the assumptions that built the modern electric vehicle industry, may not hold under the scale that industry now promises. History doesn't repeat, but it does reveal what happens when societies build critical infrastructure on resources they do not control, cannot expand, and slowly refuse to acknowledge are running out. The question is not whether this pattern applies to silver and electric vehicles. The question is what happens when everyone else realizes it does.